Hi, I'm Peter Rose, founder of Longwood Currency Trading. How do you change your Forex trading plan when the market changes or whatever goes on, where you see you should change your trading plan? Well, first of all, when would you do that? When would you change that trading plan? Well, again, it's when the market changes. I've been discussing in the last couple of videos because interest rate policy in the United States is changing from raising interest rates to we've plateaued now for a couple of periods, holding even, and now they're talking about starting this slow and gradual decrease in those rates. Well, that directly affects, as you know, the underlying value of the dollar. I'm trading dollar major pairs, and so those interest rate policy decisions are not transitory. This is establishing a new pattern of interest rates that's going to decrease. That's going to cause Treasury debt, U.S. Treasury debt, to go down. So you're getting investors in the dollar are going to be getting less money for their return. Maybe they'll decide that there are other places in the world that they could get a better return on their money. In any event, it will cause the dollar to decrease in value. So there's an example that's a dramatic example of market conditions changing. You could get market conditions change simply because, maybe the unemployment rate goes up or down drastically for a couple of months, or there's a supply shortage, and so your producer pricing goes up because the demand is high and the supply is low. And so will you need to change may need to change your methodology a little bit in order to do that. A better question to ask, rather than how should you change or when should you change your trading plan or trading rules in order to reflect the current state of the market, you should change that into you shouldn't have to. If you write good rules, if you have good methodology backed by solid processes, then those rules should be what's called extensible. In software engineering, that's the term we use for the rules that we create to program, is that we know that the business conditions are going to change. You can't go in and rewrite the rules. You need to have the rules extensible so that you just feed different conditions in and the rules know what to do with that. But most don't know how to do that. Their idea of trading is a system and rather than a methodology. And so if you're trading the London Open or engulfing candle patterns, or you're trading flag patterns or head and shoulders, or you're trading trend-based systems in one direction, and you're gonna have to change your whole rule structure when that flips around. If your rules are based on engulfing candle patterns, what happens under the conditions? And you've seen long stretches of price action where you're not going to get an engulfing candle pattern. There's a reason for that. Well, what are you going to do if your particular rules are all based on making money on engulfing candle patterns? You're screwed. You're going to have to rewrite your whole thing. Again, as a software engineer for 33 years, I had to go into other people's code and completely rewrite it because it wasn't extensible. What do you want to have to do? You want to have to rewrite your rules? But that's what happens if you don't have a good background in problem solution. You just gonna go in, and some fool told you traded 200 to 1 or 500 to 1, and you use this London Open thing or Golden Cross or fib shit or whatever it is, and all of a sudden it stops working. And you start losing money. But because you don't know how to trade, you don't know how to fix it because you don't know what's wrong. So the premise of the video was, how do you change your rules when the market changes? And the answer to that is you don't. You have to write better rules. You don't try to fix something that isn't done correctly. All you're doing is putting lipstick on a pig. That's really what you're doing. So how do you write extensible rules? There's another term that we use in software engineering, two terms actually, cohesive and loosely coupled. Loosely coupled means that the rule shouldn't have anything to do with any other rule. It's detached from all those other rules. It can send messages to those other rules and have them act on it, but it's not responsible for anything other than the message that it sends out. Which brings on the fact that it is highly cohesive. The rule needs to be designed to do one specific thing based on certain input that you provide for it. It's going to spit out one answer. And that answer might go to another rule which has the same characteristic. So when the conditions of the market change, the conditions in the rule don't change. The conditions simply change what the rule's output should be. That makes your in software engineering we would call that debugging the system, find out what the problem is. If all of a sudden your rules aren't working, you know exactly where to go in your system in order to find where the problem is. If you've written highly cohesive and loosely coupled rules, because that rule has a specific reason for existing. So when something happens, you're going to be able to say, oh, this happened, and this rule is the thing that's supposed to be controlling that, so therefore the conditions in there aren't right because they're not reacting correctly. You could fix that in 5 seconds. There's no rewriting a code like we have to do in software engineering. You just recognize what the condition is that needs to change, and then you implement that change. It's seamless. But if all your rules are talking to each other and dependent on all this other kind of stuff, you don't have an extensible system. You don't have a sequentially based system, and that's the problem. And so when the market changes, you're going to get caught, and you're going to have a horrible time trying to figure out what's wrong, and even a worse time trying to figure out how to fix that. So you need to go back to square one and find out what's the problem I got to solve, what information is that problem throwing off that would indicate that it's a problem. You take that information and you put it into this little box, and you call that box a rule. Now, what can I do in this little box to deal with this incoming information, these problems, these issues, to create conditions that recognize those issues? And those conditions need to be sequential. So if this is matches the condition, and this matches the condition, and this matches the condition, then you execute the rule. Well, what would the rule do? It would make sure that the change in the conditions coming in are accounted for in the output from that rule. Now, that output might be, instead of waiting for the profit target to get hit, you get out early. Why would you get out early? You would have a rule that does that, and there's certain conditions that say, if this is true and this is true and this is true, then get out early. If this is true but this isn't true, then don't get out early and let it go to profit target. That's an extensible rule. And that's a rule that you never have to change. Because no matter what the market does, no matter what the changes happen in the market, it's price action that the rule should be written against, not the freaking market. If you're doing a engulfing candle pattern, that's what the market is doing. How do you write a rule for that? You have to find an engulfing candle pattern, and then you act on it. What if you don't find any engulfing candle patterns? What are you going to do? You're not going to trade? Or what if you see a series of engulfing candle patterns? You see all the time with people that are teaching these indicators and these patterns and these systems, I pick engulfing candle pattern because that's the easiest one to debunk. You pull up a chart where some guy's talking about using this particular engulfing candle pattern here. And you look back in the chart and you can see other engulfing candle patterns that according to him, meet the criteria that he's using to execute on that selected candle pattern. You say, well, why didn't you execute on this one? Why didn't you execute on that one? Why didn't you execute on this one? It's because his view of a candle pattern is different than your view. Not just what he says and what the candle pattern does, but it's his view of that and the surrounding information that he has about the market and his skill at trading. You don't have that same view. How are you possibly going to use that system effectively when the market changes? If this guy is able to recognize those changes and he just has enough experience that he can make it work. It's like these guys that are using Fibonacci's. Fibonacci's have nothing to do with trading. They have nothing to do with order flow. Nothing. There's no correlation between it. It's voodoo. And yet, there are some people that say it should only go this high because that's a fib level. But what if it goes beyond that? Oh, well, it'll come off of the next fib level. Oh, well, it'll come off of the next one. Eventually, one of the fib levels will work. But it isn't because it's a fib level. It's because price action, order, flow, demand, and supply changed, and the price changed, not because some Fibonacci level was reached. You have to understand what's legit and what's voodoo, first of all. Otherwise, you're going to be building the wrong types of rules. So you've got a couple of problems facing you in building your rules. If you have any questions about that, look for those titles, deal with rules in my, I've got right now about 430 videos that I've published, so you might be able to find some answers there, or send me an email and I'd be happy to kind of discuss that with you, and I'd be happy if I can solve your problem for you in that short maybe email exchange, or maybe you'd like to set up a free consult with me, a video conference with me. I'd be happy to do that. But if you're talking about overall trading principles and things, well, you're going to need some education. You're going to need some consulting or to take a course. My courses are designed for intelligent traders that are not having the success that they should have because they don't understand these simple steps that you need to go through in order to organize your rules so that they work for you, rather than looking at the market and trying to change in real time what that rule should do. It's trading is really easy and very simple if you have the right rules. And it's very simple and easy to write those rules. How do you change your rules? You don't. It's the same thing as the joke about the calling the dog with no legs. What do you call a dog that has no legs? Well, the answer is you don't call him at all, because he's not gonna come to you anyway. Oh shit. Okay, you can tell it's late in the afternoon. I'm ready for a glass of wine. The sun's going down, and I hope that this helped. You can learn from your own mistakes, certainly, but do you have the background like I had, a degree in physics, almost a minor in math, 40 years of real estate investment, 33 years as a software engineer? I had the background to step back and say, wait a minute, this is much simpler than it's being purported out there in video land to do. And so I came up with 3 rules. I have 2 or 3 conditions for each rule. They're all in sequential order, and I can look at the chart for 15 seconds in the morning. I can look at it and go, yeah, there's something that I need to act on right now. There's something there, but I don't need to act on it right now, but I got to keep an eyeball on that. Or, nah, there ain't going to be anything I can do today. Today was one of those days where I looked at the market in the morning, and there was just nothing. It just didn't look like anything was going to happen. And there was a lot of volatility, but it was the wrong kind of volatility. It was uncertain volatility, and I said, I'm not going to trade. So I'm working on rewriting a section of, those of you who talked to me about the Fast Track course. I'm simplifying a section of discussion and moving that around and amplifying it, because it's so important. People that I'm talking with just don't get it. They don't understand this one aspect, and so I'm rewriting that part of the document to make it crystal clear as to why they better follow these rules or not. So I was working on that anyway, and I had lunch and early lunch, and I was looking at the market. Geez, that looks interesting. Up there it goes. Okay, boom, I'm in. Small lot size. Oh, it's keep going. Why should I get out? Boom, I'll go in for another couple of lots. Oh, geez, it's still going. Boom, I'll go in for another couple of lots. Whoop, my rule is telling me, okay, boom, I'm out. And so I made $500. It was about 5 minutes. That's how it works. That's how it works. You can't make this shit up in real time. You have to have those rules down so that you're not thinking about the rule. You're reacting to the rule. That's the key to it. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.